You're listening to Only in Seattle.
Buying a fixer-upper, this comes up all of the time. People want to buy a fixer-upper because they can get into the market so much easier.
Yeah.
And I've had so many people come up to me and say, hey, I want to buy a fixer. What do you think?
Yeah.
And the first thing I always do is what do you qualify for? Because you're going to probably have to go down the getting financing for a fixer. So you get short-term financing, put your house back together, and then you get the permanent financing afterwards.
Right.
So maybe explain to us how that works from the lending standpoint. So
Yeah.
when people are out looking for a fixer, whoops, just banged my microphone. Not good. Maybe explain to us how that works.
Right. I guess the number one scenario I see is somebody that's younger, they want to buy a house, they don't have a lot of money. Hey,
Yeah.
This is a house, it's in West Seattle or it's in Redmond or whatever. It is 1989 style or whatever, right? It needs a lot of work. I want to be able to fix it up. I only have a certain amount of money right now. You could put as little as money down, so you could put 3 to 5% down. If they don't have any other properties to pull equity from, sometimes they don't. If you have other property to pull equity from, that's a great way to do it. But let's just say it can be financed on traditional financing, that scenario.
Yep.
But they want to tear down the kitchen and put new master bathroom in, and maybe even a small addition or new windows, new roof, all that stuff, right?
Well, let's take a true fixer.
Yeah.
Where this house is ripped apart.
Okay, fix it like a fix, like
Somebody
really you
started
can't
a
get traditional financing.
renovation.
Yeah.
It's down to the subfloor.
Okay.
The walls are
Yeah.
studs.
Okay.
There's no
Yeah,
carpet.
that's a totally different deal, right?
Yeah.
So we can't finance that. So
Okay.
so they need to go down.
And we meaning
At Fairway, traditional mortgage lending,
conventional
loan,
Yeah.
FHA loan, can't finance it.
right.
So then we have got to refer them. For instance, I just got done from a meeting in Bellevue at Legacy Group Capital. We could refer them to them. They could finance it, and they will look at that property and go, "Hey, you're going to buy it for $400. You want to put $100,000 into it, so you're in it for $500. What is it going to appraise for, Sean,
Yeah.
when it's done?"
Right.
Okay? Because we know what it's going to look like because you're going to get plans and specs. You got a contractor. You got all the
Yeah.
cost, right?
So then on the appraisal end, we will do an appraisal considering what's there now, and then we'll have a budget and we'll have a list of the specs of what's going to be built, and then we will kind of guess what a value, we're going to extrapolate a value as of when it's done.
Right. Future value.
Future value. So we use comparable sales of homes that are renovated
Yeah.
if we have them.
Yeah. Which is nice when you have them.
Yeah. And
That helps.
oftentimes we don't. But
Yeah.
so we take our best guess. When this thing is finished, when it's been renovated, this is what we think it'll be worth. We do
Right.
an appraisal for you on that basis.
Right.
So you get the appraisal back.
Yep. So we get the appraisal back, but the private money lender will lend them the money, right? And
Yeah.
then they're going to pay, whatever it is in those fees, and they just have to have a certain amount of skin in the game, a certain amount of money in the deal, and then
How much is that usually?
I think most of the deals, if it's like an owner occupied type deal, 10%. So if they've got 10% down payment.
How about investor?
Investor, I think they're probably closer to 20, maybe
Okay.
15. It depends on the deal and how
Okay.
much equity is in it, I think.
Right.
But you're always gonna have to have some skin in the game, so to speak, when you go into private money
Okay.
lending. So then let's just say they're putting 10% in, $50K on a $50,000 project, and it's going to appraise for $625 or $650 after. Well, you've got more than 20% equity now in the after repair value or future value. So that's always that's what they're going to look at. They're going to look at the numbers more so. We're going to look at your income and assets and credit as
Right.
our
Can
piece.
you repay this loan?
Yeah.
Whereas the private lender making the fixer loan is going to say, is there going to be enough equity to sell this on the other end and make some money?
Yeah, and
Are
what's
we
your
covered?
collateral into that? So they want to make sure for us, if we're referring them a client, that we can do the permanent financing to get them approved. So they want a pre-approval from us based on the borrower's financials and credit, to make sure their debt to income ratio is low enough and whatnot.
Right.
So we can do. So if they're doing a 3 to 4 month, rehab loan, when 4 months is up and the property's done, we can now refinance them into a traditional conventional loan.
Right. And So buyers will look at a rehab loan because it's something that they can get into, and it looks like, hey, it's an affordable concept. But a lot of times from my end, when I see a first-time home buyer looking at a fixer property, I always tell them, hey, you are not equipped to handle what it's going to take to put this house back together.
Yeah, yeah. I mean, there's a lot of the unknowns, so to speak,
Yeah.
and you have to have obviously reliable contractor.
Yeah.
That says, hey, if I'm going to get this project done, and it's going to take me 3 months, it's not going to take you 6 months.
Right.
So I mean, because that's going to be expensive if they go to a private money lender.
Yeah.
Because they might pay 10% on a rehab.
A bunch of points.
If it's a fix and flip, they're definitely paying that. But if it's an owner occupied rehab, I think the rate is a little lower. Closer to a construction
you're
loan
like
rate.
10-12%.
But they're also going to pay fees, and if they go past that, that the term of the loan.
Yeah, you've got renewal fees.
Extension or renewal fees. So, you probably can have Shannon Kershaw on here again and speak better to that than me, but she's over at Legacy.
I was talking to you earlier.
Yeah.
We're going to have Brent Ely in here.
Brent for sure.
Yeah, Legacy Capital.
Yeah. So we'll refer loans to them, bridge loans, construction loans, rehab loans, since that's not our specialty. But then they want to make sure the client is pre-approved for the permanent financing.
Don't forget to subscribe to our channel and hit the notification bell so you'll know when our next video is out.